Let's start off with question 1, and we have Gilligan Incorporated reported retained earnings of $427,000 on December 31, 2014. During the year, Gilligan recorded net income of $90,050 and paid dividends of $38,000. The company had no other transactions that affected retained earnings. The question is, what must retained earnings have been on December 31, 2013? Now, note that December 31, 2013 retained earnings will be the beginning retained earnings for the year 2014. What this means is we can look at the formula to reconcile ending retained earnings and work our way backwards to get the 2013 retained earnings. Now, beginning retained earnings for the year 2014 is actually the 2013 retained earnings. So this plus net income less any dividends paid out is retained earnings at the end of 2014. So let's put 2014 beginning retained earnings, and let's remember that it is the same as December 31, 2013 retained earnings. Now, we wish to determine this information. We know net income, we know dividends, and we know the ending balance of retained earnings as $427,000. So let's indicate over here that 2013 retained earnings or 2014 beginning retained earnings plus net income less dividends equals 2014 ending retained earnings. So what it means is that the 2013 retained earnings, which is what we are actually looking for, equals $427,000 minus the net income plus the dividends, and that gives us $374,950. So retained earnings at the beginning of 2014 should be $374,950. And then when we report net income of $90,050 and pay out dividends of $38,000, we'll be left with $427,000 retained earnings at the end of 2014. So our answer is $374,950. Question number 2. As of 2014, Fisher Corporation has $10 par 4% preferred stock. 5,000 of these shares are outstanding. It also has $1 par value common stock, and the number of the common stock outstanding are 48,000 right here. Now, we are told that the preferred stock is cumulative. Now, cumulative preferred stock implies that any dividends not paid would have to be paid before the current period dividends are paid. So dividends in arrears would have to be paid. So preferred stock is cumulative, and preferred stockholders last received a dividend in 2011. So what this means is 2012 and 2013 dividends are in arrears, and because the preferred stock is cumulative, we need to pay those amounts anytime dividends are declared and paid. Now, if the company wants to distribute $2 per share to common stockholders in 2014, perhaps because it made windfall profits, what is the total amount of dividends the company must pay in the current year. Now remember that preferred stockholders have preference over receiving dividends before common stockholders. Now what this means is, if we want to pay $2 per share for the 48,000 common stock, then we should pay the preferred dividends before we can make that payment. So let's determine the preferred dividends that should be paid. Now, the preferred dividends in arrears are for 2012 and 2013. And to calculate preferred dividends, we always use the stated percentage multiplied by par. So the dividends are calculated for preferred stock using the stated percentage and the par value. So 4% of 10 multiplied by the number of preferred shares will give us preferred dividends to be paid in 1 year. However, 2 years dividends are in arrears, so we multiply this by 2. So we have 2,000 by 2, which gives us 4,000. Now, in the current year, which is 2014, we need to pay preferred dividends. And that will be again 4% by 10 by 5,000, which is 2,000. Now that we've taken care of the preferred dividends, we can now pay the common stockholders the dividends the company wants to distribute, which is $2 per share. Now there are 48,000 shares, so 2 by 48 will be 96,000. So that means in all, the total dividends to be paid will be 4,000 plus 2,000 plus 96,000, which gives us 102,000. Let's move on to the last question under shareholders' equity. And this is question number 3. On its 2013 balance sheet, Walgreen Company reports treasury stock at cost of $3,114 million. The company has a total of 1,028, 180, 150 shares issued and 946, 595, 578 shares outstanding. We are asked to determine the average price Walgreen paid for its treasury shares. Now, first off, treasury shares are repurchased shares. So when a company repurchases its shares from the market, we refer to these shares as treasury shares. Now, once treasury share transactions occur, what happens is the number of shares outstanding become less than the shares that were issued in the first place. And that is what we see here. This number of shares were issued, and because of the repurchase, the treasury shares, we now only have 946, 595, 578 shares outstanding. So to determine the shares repurchased, which are the treasury shares, we subtract 946, 595, 578 from 1,028, 180, 150, and we get 81, 584, 572. Now, the treasury shares have a total cost of $3,114 million, which means that the total cost of these shares is $3,114 million. So the average price that was paid for each share repurchased will be the total cost divided by the number of shares repurchased, and we get an approximate price of 38.17.